Very good. So we're starting our third class. Welcome, everybody, to the course. I'm going to start today finishing the the investment example that we started in class a while ago. I have assigned an assignment that requires that you do some calculations. I would like to know if anybody's having any difficulty with it. I made it due after this class in case anybody has any questions. If you have any questions, you should be asking me. And also today, I expect to end the class with a general discussion on the calculation of investment risk as it relates to volatility. Okay. So I'm going to start with any questions about the assignment, the second assignment. Any questions? No? Good. Then I'm going to share my screen, and I want to have a little bit of a class discussion. I want to start addressing some of the advanced models that we're going to be doing, and I want to do this, if possible, through a class discussion. I'm not sure if you feel comfortable doing that, but I'm going to try. So there we go. I want to go back to the example we were discussing. Here you go. And I remind you that here we were mentioning that we would need $20 million to do the deal. 20 million is because we will need 10 million from here and 10 million from there. And there was a worst case scenario that we will have to pay both. We'll have to pay the city and the ski resort. That's why we need $20 million. But now, let me pose a question. Do we really need $20 million? What happens if we don't have $20 million? Anybody has any answer? What might happen if we don't have the money? Of course, if we don't have the money, you can say we don't have a deal. It's possible. Okay, but also we could think that if we don't have the money, maybe we can still do the deal. Can we? Anybody has any comments on that? Can we do the deal if we don't have the money? Maybe you will use the chat to answer. So if we don't have the money, the answer depends. So if we don't have the money, what could happen is we can still sign the contract with the city and the ski resort. If we don't have the money, we can still have a contract. We can still do the swap. But now we may run out of money. We may have to pay the city and the ski resort, and then we don't have the money. Okay, so this is possible, and we can still have a contract, but then if we have to pay both the city and the ski resort, if we have to pay both, we don't have money. And if we don't have money, we go into a state which is called default. So default is something that happens naturally in financial markets. You have obligations and you do not fulfill the obligations. So in practice here, the city and the ski resort will probably not sign the agreement unless we put the money as security. They may ask for collateral, and I want to discuss that today. If not, then this could lead to default on our part, on the part of the fund. We discussed default last week if the city or the ski resort does not pay. But there's also the possibility that the fund does not pay if it doesn't have the money. And in that case, there will be a case of default on the part of the fund, not on the part of the ski resort or the city. Okay? Now, the possibility of default is interesting because it creates a whole set of new considerations, and that is how I want to start today. And I will be introducing the new assignment that I will ask you to do later. I will introduce that today because it has to do with this concept. Okay? Is this clear? Any questions on this? This is probably not new to you. You probably already know that. In fact, you probably also know that right now there is. Anybody has any comments on? There's a very likely case of international default coming that is very discussed. So, for example, there's a sense that very likely Russia may default on their debt. They did that in 1998. They may do it again. Argentina has done it before. Countries, every so often, they default on their debt. Even countries do that. Companies do that too. Companies go bankrupt. Okay, so. Funds could also default on their obligations. Funds could go bankrupt. So in this case, very likely, the city and the ski resort do not want the fund to go bankrupt, so they're going to demand that the money is put up front. But maybe not. Maybe not. We don't know. And if that is not the case, this leads to interesting considerations, which is what I want to start with today. So I'm going to go to where I left last time. I have introduced some additional slides to explain this, and if you have not seen them, they are on the website, so you can download them again. Okay, so we ended here with discussing the issue of capacity and what happens if we bring more money into the fund, and we can see that if we bring more money into the fund, but we don't have any more revenue, then we're going to end up lowering our performance. We saw that last week. That's how we ended. Today, I want to discuss this concept of collateral. When you do a contract, and we're going to see this throughout the course many times, when you do a contract, you typically are asked for collateral. Collateral is a means to ensure that you fulfill your obligations. You may trust someone that they will do something, but what if they don't? You want to ask for collateral. So in general, the question is, when you enter into a contract, how much money do you need? In our case, the snow swap doesn't say that you have to pay in advance. It says you have to pay if something happens. In those situations, or if you simply have a cash flows that happen in the future, in those situations, the counterparty may demand that you put collateral to ensure the payment happens. Usually, counterparties want collateral for future payments as proof of future payments. We may ask the city and the ski resort for collateral because they will have to pay money too. One example is a mortgage. When you buy a mortgage, you take a loan to buy a house. If you don't pay, the bank can take the house. The house is used as collateral for the loan. Okay? It's a collateralized loan. So like you have collateralized loans, you can have collateralized swaps, collateralized derivatives, or collateralized funds. And this is a type of borrowing. This is a type of borrowing that takes place. You can act as if you have money when you actually don't have money. Okay. So collateral is there and is to prevent the case of default. Okay. So let's see what happens. Let's see what happens in the case of our snow fund. Okay. We studied one case, which is that we need the full 20 million. The city and the ski resort may demand that we put the 20 million up front in some, it's called escrow account. That's what we have discussed. But it could happen that they don't. Or that, for example, they simply want to know that we have 20 million, but every city and every ski resort is happy to see the same 20 million. So maybe we can do this with 20 million. We just hope that we don't lose money because we don't have money to pay if we lose money. Okay, so that could be a possibility. So this is addressed as follows. We will include a number, a term, which will be called the funding ratio, that says what percentage of the money we could lose do we need to have. Maybe some cities require collateral, maybe some cities don't. That resulting percentage is called the funding ratio. Okay, and it's modeled like this. It's a number between 0 and 1 that has the effect that on average we require 20 times X, that's times X, per swap, which leads to 2X billion dollars. If X is 1, it's 2 billion, but if X is 10%, it's not 2 billion, it's 200 million. Okay? If only 1 every 10 swaps requires full collateral, then X would be 10%. The situation we have here, the first one that we discussed last week, is a situation where we are not trusted. However, if we are a big fund, we are a big bank, people will trust us and they may be willing to do the deal with us with some degree of trust, which means they trust that we will have the money, they trust that we will not default, and they will allow us to do the deal with less money than is needed. Okay, that's a possibility. And there's an extreme possibility, which is that we could do the deal with nothing, with no money. We just sign the contract, we have no money. If we have to pay, we will default because we have no money. And that is a case of extreme trust. That will only happen when you have ignorant counterparties, when the counterparties don't know what they're doing, because it's a very risky deal for them. It's very good for us, but it's a very risky deal for them. Okay? So I want to know if you understand what we are discussing here, because this is very important. Leverage, the ability to do transactions without money or with less money than required, is very important. We can do this by borrowing, or we can do this by simply entering into contracts where we don't have full collateral posted. Any questions on this? Is this understood? No? No questions? Okay, so if there are no questions, what I want to do is, I want you to do an assignment, okay? So here's the case of default. And when you have a fund like this one, there's 3 counterparties: the city, the ski resort, and the fund. And each of them could default. The city could run out of money. It has happened. The ski resort could default. We saw that in the case of Intra-West last week. That's the company that owns ski resorts, and they actually were almost going into bankruptcy. They were rescued somehow. They didn't, but they could have gone into bankruptcy, or the fund could default. Okay, there's three possibilities for default. If we are the ones, if we're in the city, we worry about the fund defaulting. We don't care about the ski resort defaulting. If we are the ski resort, we care about the fund defaulting. We don't care about the city defaulting. If we are the fund, we care about both defaulting because we get money from both. Okay? So I want to adopt the perspective of the fund, and I want you to do an exercise. I will write this maybe better, I'm not sure. You will tell me if you understand this, but this is going to be your third exercise, which I need to explain. These were the financials, if we saw this last week. These are the financials when we invest $2 billion. We see that we make a return of 10%. That's 200 million. We pay some fees, we pay some performance fees, and that gives us a performance for the fund, 7.2. But here, we are assuming that we have full funding. We are assuming that every contract we do requires that we have 20 million. What if we don't? What if we can do this with less money? What if we can do this deal with less money? What if there's a funding ratio of X? Funding ratio. If there's a funding ratio of X, what happens? That's what I want you to answer. Okay, and I want to give you some hints because I don't know if this is something that you have seen before, but I want to give you some hints. So, for the snow fund, let's assume we can enter into swaps with a funding ratio of X%. That means that the collateral we'll have is 20X. Okay? If X is 100%, it's 20 million, but if X is a 50%, it's only 10 million. That means that we can do this swap deal with less money. That means that this number will be less, is 2x billion. Okay? But what's interesting is that if this is 2x billion, this is the same. This doesn't change. Because this money is used as collateral only. The return that we get from the swaps is the same, it's still 200 million. So you will see that this number goes up. This number goes up when X is less than 1. When our funding ratio is less than 100%. And I want you to calculate, I want you to tell me how this number goes up when the funding ratio goes down. That's the next assignment. Assignment number 3. Is this clear? We still assume a fee structure of 1 and 20, exactly the same that we had here, exactly the same as that. Okay, that's a 1 and 20 fee structure. 1% management fee and 20% performance fee. Is that clear? Okay. There are no, there's no reaction, so I assume it's clear. I assume it's clear. Okay. All right. For extra points, what you can tell me is where's the probability of default of the fund? And this you can do not only this week, you can do this in the future. If you learn throughout this course how to calculate this probability of default of the fund, you can tell me and you'll get extra points. Okay, the probability of default, of course, if we have all the money, the fund will never default. We will never run out of money. The probability will be 0. But as we have less money, the probability of default will go up. Okay, and this is something which is a bit more complicated. I will explain this throughout the course, but you can come back to this, and if you do that, then you will get extra points. And I have something here that you don't have to do. But the thing that I have grayed out is not something that you have to do, but I want you to know that this analysis that you're doing here is used to come up with the credit rating of the counterparties. When you know the probability of default, you can get the credit rating of the counterparties. You may have heard of the credit rating of companies, of countries. Typically, bond issues are rated. Also, transactions are rated. Whenever there is an obligation, these obligations can be rated. And the probability of default is used for credit ratings. We're not going to see this in this course. I just want you to know, and you don't have to do this, but I want you to know that the probability of default leads to a credit rating. Okay? So, and this is something that you may already know. You may have seen this in one of your courses. I am not sure. Okay, so this is the next assignment I want you to do. And that will be for next week. Any questions? No questions. Okay, so that's the assignment. And now what I want to do is I want to finish this first section of the course before I go to the next one by giving you a glimpse of the type of trading strategies that exist. So far, we have studied one trading strategy dealing with these very strange snow swaps. Now we're going to leave that example aside and we're going to deal with the common trading strategies. Okay. And what I have here for you is an example of some of them, the type of trading strategies. So at the high level, what we have here is hedge fund ETCs, because hedge funds are the funds that have the most general trading strategies that you can have. Okay, and these hedge funds are sometimes grouped into indices that have performance numbers. We're going to be studying all of this next in this course. Equity hedge refers to a trading style which is trading stocks. Long and short, we're going to see what shorting stocks is. You probably already know, but we're going to see that, okay? But also we're going to see a type of trading which is event-driven. What is event-driven? Event-driven is a type of trading. It's a quantitative investment style that likes to trade on news, mergers, acquisitions, things like that, okay? Sometimes when a company is going to be bought by another company, this company goes up in price very much and then you trade around those themes. That's what event-driven is. We're going to see all of this in great detail. Now I'm just giving the names to you. Macro is when you think that, for example, inflation is coming, so then you invest in certain things to take advantage of inflation. Or if you think that interest rates are going to go down, what will you do? If you think interest rates are going to go down, you can trade in a certain way to make money when rates actually do go down. Or if you think a certain currency is going to go up, you can do these kinds of things. And we will see those strategies in this course. Relative value, this is a type, is a very interesting type of trade where you trade one thing against another. Okay, you trade in pairs, typically thinking that something will get bigger, some wider, or will shrink, and then you can trade to take advantage of those movements in the market. We will see that. Okay, we'll see these types of analysis. There's also regional indices that explain what happens in different parts of the world. So trading in Asia or in Europe or in Americas is different from one place to another. And we're not going to be seeing these differences. We're going to try to adopt a very general perspective on quantitative investing. But I want you to know that there are country-specific issues when you deal with those things. And then there's themes. For example, you can have, for example here, fixed income credit index, when you trade on credit instruments. credit is a theme, or when you have alternative energy, okay, wind, solar, those are themes too, or when you have the diversity index. Diversity, this is very, very interesting thing, is very common in North America. There are investors who want to invest in funds which are run by women, for example, as opposed to men, because most funds are run by men. Men are a majority. So some investors only want to invest in funds that are run by women. So you have diversity indices, and so on and so forth. You can see here the women index, okay, for example, or age, or a cultural background. There's a lot of ways of bringing investment themes into portfolios. And we will see them. We're going to focus on the quantitative aspects of that, but I also want you to know that some of these things are important from a different perspective, okay? This is more indices, very similar to the one that we saw, style indices. And then there's funds of funds. We're also going to see how funds of funds are created. We've seen how you create a fund. You can create a fund that invests in other funds. So we will see how these investment products are built. We will see this towards the end of the course. But you also have fund of fund investments with indices and performance numbers, which can be used. Regional, we already saw that, thematic, and so on and so forth. Okay, so this is the end of the first lecture. I gave you a new assignment for you to do over the next week, and now I'm going to move to the second part of my lecture notes. Any questions? If there are no questions, I'm going to switch presentations. It's going to take me a minute. No questions, good. So give me a minute to switch documents. There we go. So the next one that I have deals with the following. We have seen in the first part of this lecture, when we saw this investment, that quantitative analysis is important for us. It's in fact something that allows us to do many things. Something allows us to do many things. So what I'm going to do now is I'm going to show you how we can do that. We're going to be seeing mathematical tools that we will need to be able to quantify the investment strategies that we're going to study. Okay, so now we're going to be sharing the screen. I think this is it. Okay, investment. We're going to see some considerations on investment mathematics. I will try to make this not very abstract. I will try to make this linked to the investment theory that we have seen and that we're going to see, but we're going to spend some time looking into performance measures, measures of risk, and so on and so forth. Okay? Okay. So, first, I want to give you a broad overview of how quantitative methods have evolved over time. So you understand we're in a very precise moment in history when the amount of quantitative methods that exist is very high. But this was not like that always. 1930 was perhaps the time when this thing, this type of considerations, quantitative considerations, started. Before 1930, there was not a lot of what we now call quantitative analysis done on investments. That was the beginning, okay? There is an author, Williams, he wrote a book, The Theory of Investment Value, which is how this area started. And this gave rise to a type of investing which is called value investing. Okay? The icon of value investing is a North American, a US investor, Warren Buffett. Warren Buffett is considered to be like the example today of a value investor. And this started in the 1930s. The objective was to find a good stock and buy it at the best possible price. That's it. You may think, well, that's all I want. I want to find a good stock and buy it at the best possible price. Well, that's a very simplistic approach to investing. It's a type of investing which is very risky. It leads to mistakes that could give rise to losses, and we will see that we can do things better. Okay. In fact, 20 years later, Harry Markovich, he realized that no value was given to the concept of risk. So he developed the concept of risk for the first time. He wrote a paper on portfolio selection in 1852, okay, which people didn't really pay attention to. I have to say that Markovich got the Nobel Prize for economics in 1972, maybe, in the 70s. He got the Nobel Prize for his work 20 years after he did it, okay? And that started to change things, because then the focus was no longer find a good stock at the best price, was to do this and mix it with risk. And when you mix return with risk, now you're in control and you can do many, many things. And this created a very active type of investment strategy development that maybe peaked in the year 2000. So we're going to see all these methods that developed up until the year 2000. What's happening now is very interesting, because in the 20s, what we're seeing is that the quantitative methods that occur are based on artificial intelligence. And we're not going to see that in this course, but I want you to know that what we're seeing in this course is what has happened before the 20s. Now, a lot of these methods are done on artificial intelligence platforms. Okay? So, if you want to continue this course, then that would be the natural sequence, how you can turn what you will learn in this course over into what artificial intelligence, neural networks, machine learning algorithms can do for you. But in this course, we will stop here. We're not going to do anything using machine learning. We're going to focus on all of the algorithms that developed when the personal computer became available and everybody has access to a computer. That's what we're going to do. That's my historical explanation of the types of things that we're doing. And there's going to be a focus, constant focus in what we do, which is we're not like to turn data into information. We're going to be calculating things. But I want you to know that every time we calculate something, we do it because we want to learn something. We want to understand something. Okay? We live in a world where data is very valuable. Sometimes we have very little data, and then we have to be very smart how to use that very little data to draw conclusions. Sometimes we have the opposite. We have a lot of data, and we don't know what that data is telling us. Looks like noise. So we're going to see a lot of methods to turn data into information, whether it's a little bit or a lot. Okay. Sometimes the data we will be using is one number per month. Sometimes the data we'll be using is one number per second. The methods that we'll develop will depend whether we get one number per month or one number per second. We'll have to have methods that can do both. Okay? All right. So let me go to the first definition. We're going to see some definitions here. And the first definition I want to discuss is the definition of return. We already used that. When we're looking at the snow fund, we saw the concept of return. We were discussing the return of a swap. We were putting 20 million and we're getting 10% of that, which was 2 million. That has come up already. But when as you're about to see, we can define returns in different ways. That is only one, there is others. And in this case, what I'm going to assume is that I have a certain investment with a certain price. So this is the price of an investment at time K. K could be a day, could be a month. What we do to calculate return is we look at the value of my investment today. I subtract the value of my investment in the previous point, and I divide by the value of my investment in the previous point. So if my investment is 21 million and it was 20 before, that gives me 1. Sorry, and that's 1 divided by 20, which is 5%. Okay? That's one definition of return. That's the definition of return that everybody uses. But there's another one. It's this one here. Sometimes we use another one which is called log return. Okay, sometimes we use another one which is called log return. And log return looks at the logarithm of the division between the two values. So in this case, if it's 21 and 20, we look at this division and we look at the logarithm of that. Okay, the logarithm of this is the logarithm of 1 plus the previous return. Because this is equal to that. See, this is here. If you add 1 to this, you get exactly that. And some of you may have seen this, I don't know, but there's a result in calculus, which is Taylor's theorem, that says that this thing is very close to 5%. But it's not exactly 5%. It's close, but not exactly the same. Okay? It's close. Close. Okay, why would people do this? People do this because there are situations where one is important or another one is important. Both are good. Both are definitions. You have to know which one to use. Okay, I have an example here. I'm going to come to this. Here's the example that I have. Okay, it's an example that is coming up later. I'll use this example several times. Imagine I have an investment that is $1 right now. And then next month, I do very well. I have 2, I double. But then the next month I lose, and then I double, and then I lose, and then I double. So 1, 2, 1, 2, 1, 2. That's the value of my investment. What is the series of my returns? Well, if I do the simple returns, this month I have a return of 100%. And the next month I have a return from 2 to 1, I have a return of minus 50%. So plus 100 minus 50, plus 100 minus 50. You see? I go up and I go down. But when I go up by 100%. When I go down by 50%. So if I do some very simple statistics on this, if I look at the average, what's the average between plus 100 and minus 50? What's the average? The average is 25. So the average of this investment is 25%. But you can see that I'm not making any money. Why? Why is that? Well, let's say that I do the same analysis, but I do now my analysis not with the return, with the simple return, but with the logarithmic return. When I do it with my logarithmic return, what I see is that the first month is the logarithm, my return is the logarithm of of 2. Okay, the logarithm base e, which is the natural logarithm, that's the one that people usually use, is 0.69. And then the next month is the logarithm of a half, which is minus 0.69. See, and then the average of this is 0. If I look at the simple return, the average is 25%. If you look at the logarithmic return, the average is 0. Look at my fund. My fund goes up and down. 1, 2, 1, 2, 1, 2, 1, 2. What return do you expect to be for this fund? Can anybody answer this question? What return? Which one do you prefer? This one or this one? Who can say? Let's see, this is number 1. This is number 2. Let's have a vote. Which one do you think makes more sense to you? Number 1 or number 2? Please answer in the chat. Number 1 or number 2? Second one. I only have one answer. Second one. So do a poll. You know how to do a poll on Zoom? Okay, so everybody is saying 2, 2, 2, 2, 2, 2, 2. Exactly. So this one makes more sense, right? 0% return is what we expect. Still, most people use this one. There's no problem in using this one. There's absolutely no problem. We just need to know that this will give us some results that we don't necessarily expect. This is one of the reasons why we're going to be developing certain methods, because some methods are good for some situations and others are good for other situations. Okay, we're going to see more. Let me come back to this. Okay, so 2 definitions. And at least in that one example, all of you prefer this one. Although most of the time, everybody uses this one. Okay? That's okay. We'll use both. Now, let me continue. When we have these types of calculations, these returns, we're going to have returns which will change over time. So it's not just one number we're going to be looking at. We're going to be looking at many different numbers. For example, this one. Let me go back to my example, right? All these numbers. If this is for a year, here we have 11 numbers. 11 numbers. Because we need 2 to create one return. That's why the first or the last one are killed, right? So 11 numbers. When you have 11 numbers or more, if you have daily data for 5 years, now you have 1,000 points, right? So when you have that, what you can do is you can do statistics. And we're going to organize the data. And I don't know how much statistics you know. But when you have a random variable, which is my return, my return for all k, when you look at all possible k's, gives me a random value or a random variable, which I study using statistics or probability. Okay? That's how we're going to be dealing with all of the data that we have. We're going to assume that it's brought to us by some probabilistic or statistical considerations. So, in doing that, there's 2 types of statistics which are important to us. One is the cumulative distribution function of my portfolio, the cumulative distribution function, and I will explain what it is in a minute. And the other one is the return density. The return density, I suspect, is the one you're most familiar with. It's this yellow curve. It's the histogram of returns. Okay, I suspect you have done this before. 'Cause, you know, you have 100 points, right? And you have 100 points. 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 And you have 100 But there's another one which is very useful to us too, which is the cumulative distribution function. And I suspect you have seen this already when you study probability. This is the one that typically probability uses, the cumulative distribution function. And in the case of investments, it has a very important, it measures a very important quantity for us, which is the value at a certain point x is the probability that my return, my performance is equal to x or less. There's the probability that my return is not bigger than x. Okay, so when x is very much to the left is very low, and when it's very much to the right is very high. That's the green function. Okay? When you look at the yellow curve, that's the histogram, you will see that the points that occur very often, the returns that occur very often, typically 0, okay, or the small returns, those have a very high number. That means that they occur often. This is also called the likelihood. The likelihood. And both are related because one curve, the yellow curve, is the derivative of the green curve. And I suspect this is something new. Sorry, this is not new. You have seen this before. But let me ask a question. In the chat, please answer whether is this new to you. Is this new? Yes, it's new. You've never seen it before. No, it's not new. You have seen this before. Please answer in the chat. I want to know. Oh, no one is answering. Maybe shall we do a poll? Okay, create a poll. Okay, just hold on. No, I won't do a poll. It takes too much time. I'll do a poll later. No. Okay. Okay. Any questions? Is this so? No, meaning this is not new to you. You have seen it before. Okay. Good. Very good. So with this, we can now start to do some considerations. And in doing these considerations, I want to make one remark, which is the yellow curve. Is what we typically do when we do statistics. Is the one that we'll do most often. The green one is the one that we will do when we do theoretical considerations. For example, probability. When you do things in your computer in Excel, you typically end up with a yellow curve. You do statistics. But very often we're going to have to think about the numbers that we have in front of us, and then we will use the green curve for that. They're related. They're both the same. They're related by the derivative. Okay. Okay. So. Okay. I assume you. This is something which is. Okay, so one thing that I want to also mention is that sometimes when you do things in practice, things don't look very pretty as they do when you're doing theoretical considerations. And I'm sure you have seen that, but sometimes a nice Gaussian distribution function like this one that we have here, sometimes it looks like that, a little bit grubby, when you are only looking at only a few sample points. Okay, so you just have to be aware of that. That's why we like to have theoretical considerations, because sometimes the actual data we have in front of us doesn't tell us the whole truth. Okay, and so equipped with this perspective, we can start to do portfolio statistics now. Okay, and in doing portfolio statistics, what again I want to do is I'm going to do two types of developments here, of explanations. One are practical, like for example, the definition of return is not this. The definition of return is something that probabilists do, and they tell us, and there's a certain formula for it. But in our case, when we're studying investments, this thing has a particular formula. This formula is what's called an estimator. Is the estimator of this. This is an abstract concept. That's the abstract definition. The estimator corresponds to an abstract definition. Okay? It's an abstract definition. And this is something that we can do in Excel, for example. But there's going to be some considerations when we do that. This is perhaps the first formula that we see here. With this comes this. This is the standard deviation. The standard deviation is another way of studying portfolio statistics. In fact, it's the one that I asked you to do on your second assignment. It's something that we saw last week and the week before. It was the one that allows us to understand the concept of portfolio risk. And the thing is that the standard deviation is not defined like this. The definition is here also. It's a very precise and abstract definition. In practical terms, it can be done like that. But when you do things in practical terms, there are considerations. Like, for example, who can tell me the difference between this or 1 over n? Why do I have 1 over n minus 1 and not 1 over n? Who can tell me the difference? I want to know if you know the difference. Why I'm doing 1 over n and not 1 over n minus 1? Anybody can answer, or maybe write in the chat if you don't want to speak. No answers? Okay. The reason that we have this n minus 1 here is that, see, this mean return that I have here uses the same sample. So from a statistics perspective, here we have lost 1 degree of freedom, and the degrees of freedom are here. That's the degrees of freedom. Okay, so this is a better estimator than if I divide by n. However, we have divided by n in the past when we calculated the snow fund risk, and I asked you to do the same when you do the standard deviation or the volatility of this other investment in the assignment. Okay, so there you divide by n, not by n minus 1, but so you know, usually you divide by n minus 1 because it's a slightly better estimator. The difference is very low. It's very, very low. 1 over n minus 1 is very low, but these considerations appear and are important when you're doing statistics. Okay, so anyway, that's the definition. That's not the definition. That's the formula. That's the estimator for the volatility. That's the estimator for the return, the average return, and the average volatility. Okay, and here is when this example now has full significance, because when you have an investment like this one, maybe you expect the average return to be 0, but then you see the average return is actually 25%. We already saw that. This is because we are using the simple return, and the simple return is biased. That's where we get a bigger number. If you use the logarithmic return, it's 0. So, and you can use these expressions either. You can use these expressions, see, when you look at the average return, these could be either log or simple. It doesn't matter, okay? Each of them gives you different statistics, and this is what we have here. So the log return gives us 0, and the average return gives us 25. When you look at the volatility of this is 75%, the volatility of this is 70%. What is the volatility? Well, the volatility in this case is 100%, which is 1, times a half, plus minus 50, which is a half squared, times a half, and the square root of that, 75%. Okay? And in this case, that would be 0.69 squared times a half plus 0.69 squared times a half square root of that, 70%. Okay. To be exact, is at 0.6931% to be exact. Okay, but we round up. So all of this, I suspect it's all clear. You told me that you already saw this. So this is how we're going to be doing portfolio statistics. But we have to be careful with the statistics, because sometimes the statistics is not what we expect them to be. They're not wrong. This is right. But it's also misleading. Because it seems to indicate this fund makes money, makes 25% return. It doesn't make money. The fact that the average return is positive does not mean that the fund makes money. So we have to be very careful when we do calculations. Sometimes the calculations do not reflect what we expect these calculations to mean. So we have to understand the calculations that we do very well. Okay? All right. And to make things more interesting, there are not only two, but very many types of returns that you can use, because we have seen the simple and the logarithmic return, but then with that you can do returns which are reported monthly, annual, annualized. What's the difference between annual and annualized? What's the difference? They're different. The annualized is the monthly times 12, which is different from the annual, right? Do you see the difference? Okay, just in case you don't see the difference, let's go here. What's the annual return here? 0. Because from January to January you don't make any money, so the annual return is 0%. What's the annualized? Is 25 times 12%. See? Very different. Very different. So we have to be careful when we look at these numbers, okay? Average monthly, okay? Annual compounded. And then we're going to see two new ones, which is the time-weighted rate of return and the internal rate of return. These are the next ones that I'm going to define for you, okay? So now, before I give you those definitions, what I have here is the following in consideration. This is how the return of a certain investment will look over time. This is just an example, okay? And it's called the running mean. Mean, why? Because this is the mean. I'm taking a 2-year window, and I run it through time, right? I run it through time. And then what you see is that the return, the mean return is here. These are different investments I have in here, right? So this one is here, then it goes down, then goes up. So this mean return is not constant, goes up and goes down. And when something is not constant, goes up and goes down, that means that it's random. And therefore, it is very important for us to understand the source of that randomness. Okay? When you look at the standard deviation, you have a similar behavior. You have a certain value, and then goes up, and then it goes down. Okay? And we also want to understand that behavior. Who can explain this thing to me? These are things you can actually see. Look at the dates. Who can explain this to me? Why does this thing go up and then down? Can you explain this? It doesn't matter what these investments are. It doesn't matter. Okay. This is the standard deviation, which is the risk. Who can explain to me why this thing goes up and then down? This is from 2009 and 2011. This is 2 years. Well, it's right here. This is the beginning of the financial crisis. And that's exactly 2 years after the beginning of the financial crisis. So when you have, I want you to be aware of one thing. When you look at the formula for the standard deviation, which is here, look at this. If you use this on a 2-year window, and you have a big event, one big event, what happens? That when that big event is in your sum, this number will be very big. But when that big event has left the sum, which is 2 years later, this number comes down and is smaller now. You see? So sometimes this has a name. This is called a numerical artifact. Numerical artifact. And this is what we see here. Here we see a numerical artifact. Because something happened there. There was an event there, a big event. And that big event lives for 2 years, exactly 2 years in our calculation, because we are running a 2-year window. This is a running standard deviation with a 2-year window. Okay? It doesn't mean that the crisis lasted 2 years. No. Our estimator will look at the crisis for 2 years, and then in year 3, the crisis is no longer in our formula. That's why the value comes down. Okay? So these estimators have a memory. And we also need to understand that sometimes these numerical artifacts are due to memory. So just as important as it is going to be to know a lot of quantitative methods, we also need to know that some of these quantitative methods, sometimes they give rise to numerical artifacts, which have no interpretation beyond just a numerical calculation. Okay? So these are another things that we'll have to learn. And finally, I have this picture for you. And this picture has a meaning. How much do you know? Let me ask you a question. How much do you know about machine learning and artificial intelligence? Can you write on the chat if you know artificial intelligence and machine learning, yes or no? Please write yes or no in the chat. Yes, no, 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 yes. Okay. So some people yes, some people no. No. Okay. All right. So let me give you a hint as to what artificial intelligence and machine learning does. Okay, I'll give you a hint. What I have here is this. I have 3 types of investments. I have stocks in orange. I have bonds in blue, and I have hedge funds in gray. Okay? So bonds are in blue, stocks are in orange, and hedge funds are in gray. And as we saw earlier, if you look at the mean, what I have here is this is the mean. This is the mean, and this is the standard deviation. And as we saw earlier, the mean goes all the way. The mean goes all the way. Yeah? So it goes up and down, it's all of that. Sorry, no, this is not the mean. I made a mistake. Sorry, I made a mistake. Sorry, I made a mistake. Now, this is the standard deviation, and this is the mean. Sorry, I made a mistake, okay? This is the standard deviation, and this is the mean. And what we can see is that the standard deviation has this variability. The mean goes up and down, but the standard deviation has this variability for the stocks, but then for the bonds, and then for the hedge funds. So what can we say when we put things into this plane, into this perspective? What we can see clearly is that stocks have higher risk, bonds have medium risk, and hedge funds have lower risk. It's quite clear by looking at the picture. If I look at the series that is given to me, it's just chaos. It's just a lot of charts going up and down. But if I organize it like this, it's very significant. And this is what machine learning is used for. Computers have a way of finding what is the right perspective on things, and then they present it to us in a digested manner when they say, this is what things look like here and there and there. Okay? This is a very simple example that explains that. Okay. So this is how we approach return. And then, as I mentioned, there are considerations about the return over time. So I want to start with this first one. It's called the time-weighted rate of return. And it's the one that you probably already know. It's the one that you have seen. If you have a certain return after one period, you have a return to one period, then second period, then third period, then you compound them. You compound these returns. And when you compound these returns, you end up with a compounded rate of return, which is this one. Yes, this is what you have seen, I'm sure. I don't know that you have seen this one, that I will explain next, but I am pretty sure you have seen this, I think. Yes? Okay, well, this has a very interesting, this is all good, it's a definition, but it has a very interesting consequence, and I have it here. So let me present this example to you. It's another fund that I have. I start again with $1, and look what happens to this fund. Okay? I have my dollar, and I invest it, and then I have two. So I double my investment. Then I double my investment again, and I double, and I double, and I double, and I keep on doubling. I double all the time. Okay? And then I get to the beginning of November, and my $1 has grown to $1,000. I'm a genius. This is fantastic. I'm so good that my good friend Jack Ma says, oh, you're very good. Let me give you $1 billion. I'll give you $1 billion. So you invest it. Great. And then the month of December, I lose half of it. Okay, so the month of December, I lose half of it. I lose $500 million. I lose $500 million. You understand what I'm doing? When I have a very little money, I have very good performance. When I have a lot of money, I have very bad performance. You see? Well, what is the return of my investment, my return over time? Well, if I do my cumulative performance, it's fantastic. My return at the end, my return when I have lost $500 million, my return is 102,000%. And you may be wondering, why do I have a high return when I have lost a lot of money? And the reason is here, because in this compounding, I don't take into consideration how much money I have lost or made. I only look at the return. The return is independent on how much money I'm investing. You see? Is that a problem? Is that a problem? Well, sometimes it is a problem because when people, when you, again, we want to turn information, sorry, we want to take data into information. All this data here is a lot of data. If all of this data is summarized into a single number, is this giving us the right information? If I simply say that a fund has had a return of 102,000%, is that good information? It's not good information because it misses one very important fact, that the fund lost $500 million. This number, which is in my database, and this analytics on this whole thing do not agree. Okay? So because of that, we need to have other ways of expressing the investment reality. And the other way that we have is this other definition that we have here. It's called the internal rate of return. That's the name. And the internal rate of return, what it does is the following thing. It looks for a number, R, such that the numbers, the cash flows that you have, the inflows into your fund, the money that is given to you, if you apply this rate of return to it, you end up with the final value for the fund. So here, in our example, we have two cash flows. The $1 I invest at the beginning of January and the $1 billion that I invest in December. And the end result that I have is $500 million. That's it. So I have 1 billion of inflows and $500 million of final value. So when I put this thing together, this expression is difficult because I have to solve an equation. And the solution of this equation is tricky. This is what is called an implicit equation. Okay, where this is the variable. So this is not a number that is given with a formula. This is a number that is given through an implicit equation. It's not explicit, it's implicit. It's the same formula that you have when you do the yield for a bond. Okay, so I think you have seen it before. Anyway, so when I use that in this particular example, the return that I'm looking at is the number R that will make this expression, this plus that, my inflow equal to 500 million. So this number is very close to minus 50%. So the internal rate of return is equal to minus 50%, but the time weighted rate of return is 102,000%. Which number do you prefer? Both are correct, and both are good, and both are useful. Which one do you prefer? Well, I don't know which one you prefer. I'm pretty sure you prefer this one. This one has more information than this one. This has no information, right? So again here, we see two definitions of returns over time, and the one that you probably prefer now is not the one that people use. People use this one. That's the one that people use, okay? But sometimes you want to know that one. So these are quantitative methods which are used to understand fund performance, okay? Now there's more. I'm going to continue. There's more. This one, I'm not going to pay a lot of attention to. This is very sophisticated. I will just mention it. I just mentioned something, and this is called market timing alpha. Market timing alpha, and imagine that I have two examples of two trading strategies. Okay, in this fund, I invest $100 or $100, doesn't matter, $100. Okay, and then I invest in a market. The market goes up and goes down, down and up, okay? Have a certain this is what the market does. It goes up and it goes down. And this is investment number one. This is investment number one, and this is investment number two. In investment number one, you see investment number one and number two is the same thing. The market does the same thing. The market does the same thing. My fund has the same returns. The difference is that in this fund, I invest and I hold. This is called buy and hold. This is a term for this. It's called buy and hold. I don't do any investment. I just invest one time and then I just don't touch my portfolio. But in this one, you see, I invest more and then I take some money out. I go in and I go out. I invest an additional $100 and then I take $100 out. And the thing is that I invest $100 when my portfolio has come down in value. And I take my $100 out when it has come up in value. You see? When the market goes down, I invest, and when it goes up, I sell. That's what I do here. But here, I do nothing. Here, I do nothing. I do not change my portfolio. I do not change my portfolio. So this thing has a name. This is what's called active. Oh, sorry, this is active management. And this one is called passive management. And if I look at the time-weighted rate of return, they are the same. And then you may be thinking, how come they are the same if one is making money and one is not making money? Same thing. Because one is investing money in an active way. The performance is the same, but in this one, in the second one, when the fund comes down in value, I put more money and then I take it out when the fund comes up in value. The time-weighted rate of return is still the same, because that ignores cash flows, okay? But when I look at the actual internal rate of return, in the first one, the internal rate of return is 0, but in the second one is positive, is 13%. So that 13% is a measure of what my active management is contributing to my fund performance. Okay? So what I'm saying here is that this is not always the case, but the difference between the internal rate of return and the time-weighted rate of return is active management, or market timing alpha. Okay? It's called alpha because, well, we'll see why it's called alpha later when we look at linear regression. But the difference between the IRR when the time-weighted rate of return is the same is what we will call market timing alpha. Okay? This is a difficult concept. I'm just introducing it to you so that you have an idea. This is something which is very important. Okay? Now I'm going to continue because I want to finish something before the end of class, because now this is going to equip us very well to start to do some portfolio theory, which is what I will do next week. Okay? The next object I want to define here is the correlation that you already know, but I want to make sure, and I want to make sure that we use the same notation. So when you have two funds with daily or monthly returns given by random variables x and y, the covariance has a definition, which is the expectation of the central product of returns, or and a formula for the estimator. This is the estimator. This is the estimator. This is the monthly returns, that's the average, monthly average. That's the covariance between two fund returns. And then the correlation is the ratio between the covariance and the product of the standard deviations. And there is a mathematical theorem that says that this number, the correlation, will always be between -1 and +1. Because of that is expressed in percentage points, and therefore we would say that this is between -100% and 100%. Very nice number, between -1 and 1. If it's 1, that means that there's a relationship between our investments. They move together. And if it's low, that means that the investments do different things. Investments that do different things, investments that have negative correlation, are wonderful, because you put them together in the portfolio and they balance each other out. This is the principle of hedging. Hedging is removing risk from the portfolio. When you're investing, obtaining higher returns is difficult, but lowering the risk is something that can be done. They say that it's the only thing you can get for free in the world of investments, is the lowering of the risk. And the lowering of the risk is something which is based on the concept of correlation. Low correlations are the ones that allow us to lower the risk of our investments. Okay? So this is a very important concept. This thing here, very important concept, because this is how we lower the risk. This contributes to lower risk. Risk is bad, so if it's lower, it's good. This is something we're going to see this in precise form in the next few minutes or next week. This is going to be a very important topic for us. How we lower the risk. Making returns higher is difficult, but making risk lower is easier. And then we will see that if we can make the risk lower, we will be able to make the returns higher. So this is the formula, which is the basis for a lot of things. And very likely this is how I will end today, with this formula. So imagine a portfolio. A portfolio has a name. I call it Pi. Pi is for portfolio. Do you know Greek? I don't know Greek, but this is a Greek letter. It's the Greek letter corresponds to the letter P in Greek. P, capital P, Pi. Okay. So if this portfolio allocates this amounts of money or percentage of value to assets that have random variables X, so that's my portfolio, right? This is my portfolio. WI to asset XI. My portfolio is the sum of all of them. That's my portfolio. The volatility of that portfolio, the one that you are calculating on your assignment number 2, when you have a portfolio of different assets, has a formula. And the formula is this. The volatility of the portfolio is the expectation of the product. The expectation of the product is written like that, with those things and the comma. That means the expectation of the product. Product expectation. Okay? The expectation of the product or the portfolio against itself, which happens to be this. And this is the covariance. That's the covariance. So you see, the volatility of my portfolio is the product of the allocations to each of the funds times the covariance between those funds. The covariance has this structure where I and j run through 1 and n. Because of that, this is usually written as a matrix. And it's called the covariance matrix. And the covariance matrix is written in matricial form like that. This is a matrix. That's the matrix of my covariance numbers organized as a matrix that I know you've seen before. And if now I organize my assets as a vector, what I have is that the square of the portfolio volatility, the portfolio variance is the matricial product between my asset vector, my covariance matrix, and my asset vector transposed. Or in other words, my portfolio volatility is the square root of the matricial product between my asset vector covariance matrix and asset vector transposed. Okay? This formula is extremely useful. And it has some consequences. One consequence is that, as you can see, if the correlations are negative, then this number will make the sum less. So portfolio volatility decreases when correlation is low. So low correlation implies low portfolio volatility. This is the reason why investors want to invest in uncorrelated assets. We are looking for assets that have low correlation or even negative correlation, because then we can make risk come down. We can make risk disappear. We already saw in the Snow Fund that if we can make risk lower, we can make risk disappear, our investment is better. It's as if we make more money. In the case of the Snow Fund, we made the risk disappear by having more snow swaps that had zero correlation. That's exactly what we're doing here. What we did with the snow swaps, how we constructed our portfolio 100 swaps, and the fact that the correlation dropped from 50% to 5% is exactly this. This is the formula that describes that in a general setting. Okay? So we have just presented the formula that explains what we did in the first day of classes. This is going to have very far-reaching consequences, and I will see those consequences starting next week.